There is a pattern in market history that has crushed people who were absolutely certain for more than a century. Not because they lacked intelligence, and not because they misunderstood value, but because they stood inside a structure that does not tolerate crowding for very long. In 2025, that structure isn't hiding anymore. It won't show up as one catastrophic headline. It shows up as pressure quietly building where exits are already narrow. And that quietness is precisely what makes it dangerous. In 1907, the United States wasn't facing war, famine, or the collapse of a famous bubble. The stress began inside trust companies that were assumed to be safe, liquid, and dependable. As confidence thinned, withdrawals accelerated, and liquidity retreated from the very institutions designed to provide it. By the end of the year, the stock market had fallen close to 50% from its 1906 peak, not because businesses vanished, but because cash stopped moving when it was needed most. The economy didn't fail first, the plumbing did. 22 years later, October 1929 entered history as a crash. But the opening damage didn't unfold over months or quarters, it unfolded in days. On October 28th, the Dow Jones Industrial Average fell roughly 13%. On October 29th, it dropped another 12%. Nearly a quarter of market value disappeared in 48 hours, not because new information arrived, but because exits failed under pressure. Confidence wasn't debated, it was liquidated. That is the mechanism. When too many people need the same exit at the same time, the market stops functioning as a place for opinions. It becomes a system governed by constraint. Prices stop reflecting what participants believe and start reflecting what they must do. The shift is subtle at first, and then absolute. Once it happens, timing replaces conviction. This is why moments like these are often misunderstood. From the outside, they appear emotional, even chaotic. From the inside, they are mechanical. Supply collides with obligation, and time determines severity. The market doesn't ask who is right. It asks who must move. In this kind of environment, risk does not announce itself loudly. It accumulates quietly, in positioning that looks reasonable and widely shared. Alignment replaces disagreement, and consensus replaces caution. Flexibility erodes without being noticed. By the time stress becomes visible on price, discretion has already been lost. At the center of this process sits a simple but unforgiving reality: markets do not need reasons to rise. They only need sellers to disappear. When selling becomes constrained while buying remains mandatory, price detaches from narrative. What looks like enthusiasm often turns out to be pressure. This is where short selling becomes vulnerable. At its core, a short position is a contract with time. You borrow something you don't own, sell it, and expect time to remain cooperative long enough to buy it back under better conditions. When liquidity is deep and volatility contained, that contract feels stable. Time absorbs error. Patience works. But that stability is conditional. When liquidity thins or volatility expands, time stops cooperating. The short position changes character, quietly at first. It ceases to be an opinion and becomes an obligation. What once felt manageable begins to feel heavy. The clock no longer smooths outcomes. It sharpens them. This is the point many participants resist acknowledging. A short squeeze does not begin with a dramatic price spike. It begins earlier, when positioning becomes crowded inside a system that cannot support synchronized exits. The danger is not disagreement. The danger is alignment. Optionality disappears before anyone notices it's gone. In moments like this, the market resembles a city that suddenly reverses traffic flow. Those moving with the current feel little resistance and barely register the change. Those moving against it become exposed instantly. On ordinary days, contrarian positioning can weave through gaps. When the flow turns all at once, contrarianism becomes liability. Once trapped, adjustment is no longer voluntary. Positions must reverse not because beliefs change, but because survival demands it. The danger lies in simultaneity. When many participants are forced to act at the same time, pressure does not dissipate. It concentrates. And concentrated pressure does not resolve gently. From the outside, price charts look emotional. Inside the system, the process is precise. Buying becomes mandatory. Selling becomes scarce. The violence of the move does not come from excitement or fear, it comes from necessity. And necessity does not negotiate. Margin is what enforces that necessity. It does not care about narrative, valuation, or long-term correctness. It operates on thresholds. When volatility rises or liquidity thins, those thresholds move closer. Positions are reduced not because they are wrong, but because they exceed tolerance. When several thresholds are crossed together, the system reacts as one. For much of the period after 2008, this dynamic remained muted. Interest rates stayed low, borrowing costs were minimal, and volatility was repeatedly suppressed. Short positions felt light. Being early was survivable. Errors could be carried forward in time, but that environment was an exception, not a rule. As conditions shift, the underlying structure reasserts itself. Capital becomes more expensive. Volatility responds faster. Margin sensitivity increases. Short positions accumulate weight even when prices stand still. In this environment, Being right in theory is no longer enough. Timing becomes decisive. Markets under these conditions stop rewarding certainty. They reward flexibility. Rigid positioning, especially when widely shared, becomes fragile. Small disturbances propagate quickly. Adjustments that once unfolded gradually compress into bursts. Pressure that was once diffused becomes localized. This is the stage where patterns matter more than forecasts. The system does not announce what it will do next. It reveals how it behaves under constraint. History does not repeat exact events, but it repeats responses. When liquidity withdraws, exits narrow, and positioning crowds, the sequence becomes familiar. This is not a warning, and it is not a prediction. It is simply the first phase of a familiar structure revealing itself again. The system has not changed. Only the conditions have begun to look familiar. Market pressure rarely arrives loudly. It arrives as discomfort. Prices begin to move without news. Spreads widen in places no one is watching. Trades that once cleared instantly hesitate, then slip. Nothing looks broken yet, but nothing feels smooth either. Liquidity is still there technically, but it no longer waits. And when liquidity stops waiting, time becomes expensive. This is the point where structure overtakes story. Long before panic appears, exits begin to narrow. Timing grows sensitive. Positions that once felt flexible resist adjustment. The more crowded those positions are, the less tolerance the system has for delay. Pressure accumulates quietly, without explanation. History shows what happens when that pressure is ignored. In October 2008, the logic across global markets felt airtight. Demand was collapsing, credit was frozen, and industrial Europe looked indefensible. By September 2008, the STOXX Europe 600 Automobiles Index was already down more than 45% from its 2007 high. For many funds, shorting Volkswagen did not feel aggressive, it felt inevitable. What most participants missed was not a headline, but a number. By late 2008, Porsche had quietly secured control over roughly 74.1% of Volkswagen's voting shares. The German state of Lower Saxony held close to 20%. That left barely 6% of shares truly available for trading. At the same time, estimated short interest had climbed well beyond that remaining float. The trade was crowded. The exit was theoretical. When short sellers tried to close positions, the market didn't slide. It froze. Offers disappeared. Volume thinned. Prices stopped moving in steps and began jumping entire ranges. Between October 24th and October 28th, 2008, Volkswagen shares surged more than 300%, briefly pushing the company's market capitalization above 300 billion euros and making it, for a moment, the most valuable company on earth. Not because belief changed, because exits vanished. Price stopped answering the question of value. It answered a different question instead. What does escape cost? Short sellers did not buy because they were convinced. They bought because they had no alternative. The market was not euphoric, it was cornered. And the quiet before the move was not calm. It was absence of liquidity, of choice, of time. When exits reopened, even slightly, the reversal was violent. Volkswagen shares fell more than 60% in the days that followed. The squeeze did not resolve into stability. It resolved into exhaustion. Pressure released, then left behind damage no chart could fully explain. Many dismissed Volkswagen 2008 as an anomaly. That was the mistake. The lesson had nothing to do with the company. It was structural. When supply is constrained and obligations are forced, markets stop behaving like markets. They behave like bottlenecks. And bottlenecks do not care about conviction. 13 years later, the same mechanism reappeared in a different costume. January 2021. GameStop. The fundamentals were debated endlessly, but positioning told the real story. By early January, reported short interest had climbed above 100% of the public float. On January 4, 2021, estimates placed it around 141.8%. More shares had been sold short than physically existed for trading. On paper, the system allowed it. In reality, it loaded the spring. As prices began to rise, time turned hostile. Short sellers were no longer managing opinions. They were managing survival. Each forced purchase removed available supply. Each removal tightened the noose for the next position. Margin requirements increased. Losses accelerated. Buying stopped being strategic and became mandatory. No coordination was required. No conspiracy was necessary. Structure alone was enough. Rising prices forced covering. Covering reduced supply. Reduced supply pushed prices higher. The loop fed itself. Between January 13th and January 28th, 2021, GameStop shares rose from under $20 to an intraday high above $480. The move looked irrational. The mechanism was not. From the outside, these episodes are framed as mania or speculation. That explanation is comforting. It is also incomplete. Emotion explains how it feels. Structure explains why it happens. Volkswagen 2008 and GameStop 2021 occurred in different decades, different markets, different regimes. The sequence was identical: alignment, constraint, forced movement. This is where risk is often misunderstood. Many expect danger to arrive through falling prices. But in compressed structures, rising prices are the real threat. They close exits. They compress time. They activate obligations that cannot wait. Markets, in these moments, behave less like voting machines and more like pressure systems. They respond to imbalance, not belief. Once pressure crosses a threshold, release becomes unavoidable. The only uncertainty is where it concentrates. These episodes were not warnings about specific stocks. They were demonstrations of limits. By the time they are recognized for what they are, the mechanics have already finished their work. Explanations arrive late, history leaves its mark quietly. And the shape it leaves behind is always the same.
By the time markets reached 2023, the environment had already changed in ways that were easy to underestimate. Interest rates were no longer an afterthought. Between March 2022 and July 2023, the Federal Reserve raised its policy rate from near zero to above 5%. The fastest tightening cycle in more than 40 years. Capital stopped being patient. Liquidity stopped being generous. Own structures that relied on time suddenly found time working against them. This shift did not arrive as panic. It arrived as weight. Borrowing costs rose quietly, then persistently. Carry trades that once felt invisible began to show up on balance sheets. Margin sensitivity tightened across desks that had grown accustomed to forgiveness. Positions did not fail immediately, but they became heavier to hold. The system did not break. It hardened. Liquidity changed character as well. Market depth that once absorbed stress retreated. Bid-ask spreads widened in places that rarely made headlines. Market makers reduced risk, not out of fear, but out of arithmetic. When balance sheet costs rise, tolerance falls. And when tolerance falls, small shocks travel farther. In this environment, price behavior began to change subtly. Moves became sharper. Reversals became faster. Instruments skipped through levels where trading used to occur. What looked like volatility was often just absence. Absence of size. Absence of willingness. Absence of someone on the other side. Short positions felt this change first. They always do. When rates were near zero, time acted as insulation. A short position could be early and survive. Carry costs were manageable. Drawdowns could be endured. But once rates climbed above 5%, time stopped absorbing mistakes. It amplified them. Every day a position remained open had a price. This altered the psychology of risk. Traders did not suddenly become less confident. They became less flexible. When flexibility disappears, positions become brittle. And brittle positions fail differently. They do not unwind gradually, they snap. Signs of this brittleness began to appear in fragments. Sudden rallies without news. Single-day moves that erased weeks of positioning. Gaps that skipped liquidity entirely. These were not broad market events. They were localized stress releases. Pressure finding the thinnest exits. In 2023 alone, several heavily shorted names experienced one-day gains exceeding 40% without fundamental catalysts. In some cases, borrow rates spiked into double digits within hours. In others, trading halts interrupted moves that no longer respected normal flow. Each episode looked isolated. Together, they formed a pattern. This is how structural stress behaves in modern markets. It does not concentrate in one place. It migrates. It looks for pockets where alignment is dense and liquidity is thin. It releases pressure briefly, then moves on. The system does not need a collapse. It vents. This is why many observers misread the moment. They look for a single event that confirms danger. They wait for headlines. But structural stress rarely announces itself so cleanly. It signals through irregularity, through movements that feel out of proportion, through prices that act first and explain later. Markets in this phase do not trend smoothly. They lurch. Periods of calm are interrupted by sharp repricing. Confidence returns briefly, then evaporates. Participants adjust, then over-adjust. The system oscillates, not because it is unstable, but because it is tight. Run tolerance is low. Small inputs create large outputs. This environment is particularly hostile to crowded positions. When too many participants share the same exposure, even modest price movement can trigger forced behavior. Margin thresholds are crossed faster. Risk limits are reached sooner. Decisions compress into reactions. Importantly, this does not require widespread speculation. It does not require retail participation. It does not require narrative enthusiasm. It only requires alignment inside a constrained system. When those conditions exist, outcomes follow. By 2024, this dynamic had become familiar to those paying attention. The market no longer rewarded patience indiscriminately. It rewarded adaptability. Positions that could move survived. Positions that relied on time struggled. The system favored flexibility over conviction. This is the quiet escalation that often precedes larger releases. Not a build-up of fear, but a build-up of sensitivity. The margin for error, reaction time shortens. Pressure accumulates in places that appear stable until they aren't. In moments like this, history does not offer prediction. It offers orientation. The same ingredients that powered past squeezes are visible again. Higher carrying costs, thinner liquidity, crowded positioning, and reduced tolerance for delay. None of these guarantee a specific outcome, but together, they lower the threshold for disruption. This is why the phrase "it's happening" circulates without clarity. It does not point to a single chart or a single asset. It reflects recognition. Recognition that the system is behaving in a familiar way. Recognition that structure, not story, is in control. Pressure does not need to explode to matter. It only needs to move, too. And in this environment, it is already moving.
What happens next in systems like this is rarely cinematic. There is no single moment where everything breaks at once. Pressure releases unevenly, wherever exits are thinnest and alignment is densest. The system does not seek drama. It seeks relief. And relief, in financial structures, often arrives as force. The final misunderstanding is also the most dangerous one. Many believe risk announces itself through falling prices. They wait for red screens, for panic, for fear. But in compressed structures, rising prices are often the trigger. They close exits instead of opening them. They shorten time instead of extending it. And they convert disagreement into obligation. This is why short squeezes feel so disorienting. Price moves upward, yet stress increases. Losses expand faster than conviction can adjust. Margin does not pause to confirm reasoning. It executes. And when execution replaces discretion, markets stop asking permission. History offers quiet confirmation of this sequence. In 1907, it was not falling prices that broke confidence first, but the withdrawal of liquidity from trust companies. In 1929, the decisive damage occurred in 2 days, not through debate, but through forced selling. In 2008, price became an exit fee when supply was locked. In 2021, price exploded when paper supply exceeded reality. These events are often treated as exceptions. They are not. They are expressions of the same underlying response. When exits narrow and obligations rise, markets abandon gradual adjustment. They move in jumps. They overshoot. They correct violently. Not because participants lose control, but because the structure removes it. In the present environment, this mechanism does not need to dominate the entire market to matter. It only needs to appear in pockets. One asset, one sector, one crowded exposure. Pressure concentrates locally, then releases, leaving scars disproportionate to the size of the move. This is why recent episodes feel disconnected. A sudden rally here, a violent reversal there. Each looks isolated. Together, they map stress migration. Pressure does not disappear. It relocates. It searches for the next weakest boundary. Markets under these conditions stop behaving like narratives and start behaving like systems. Cause and effect compress. Explanations arrive after outcomes. Confidence follows price, not the other way around. Participants react to movement rather than anticipate it. In this phase, timing matters more than correctness. A position can be right and still fail. Not because the thesis is flawed, but because the structure cannot support the weight. Time, once an ally, becomes an adversary. And the market enforces that shift without apology. This is where many seasoned participants grow quiet. Not because they see disaster, but because they recognize the setup. They have seen the sequence before. Alignment, constraint, forced movement, release. The pattern does not require repetition to be understood. The phrase "it's happening" does not point to a climax. It points to a condition. A recognition that the system is operating under familiar constraints. That sensitivity has increased. That tolerance has decreased. And that outcomes will be shaped more by structure than by story. Nothing in this process guarantees a single dramatic event. Systems can relieve pressure in fragments. They can reset locally without collapsing globally. But each release leaves less room than before. Each adjustment tightens the next. This is why the absence of catastrophe is not reassurance, it is context. Markets that feel calm on the surface can be tense underneath. Liquidity can appear present until it is needed. Stability can persist until alignment makes it fragile. These states are not contradictions, they are stages. What history teaches is not what will happen next, but how the system behaves when it does happen. The response is consistent, the timing is not. Structures do not promise outcomes. They constrain them. By the time clarity arrives, the mechanics have already acted. Participants search for explanations, but explanation is always late. Price has already moved. Obligations have already been enforced. Pressure has already chosen its exit. This is not a forecast, it is not a warning. It is a description of how the machinery works when placed under familiar stress. The system does not change its nature. Only the conditions around it do. And when those conditions align, movement follows. Quietly at first. Then all at once.